Around 2008, a large number of subprime mortgages led to the largest financial crisis since the Great Depression. These mortgages created toxic assets when loan holders did not pay the interest owing. The shadow banking sector was shaken and laymen filed for Chapter 11 bankruptcy. This occurred before the Emergency Economic Stabilization Act 2008 was passed and the Federal Reserve stated they did not have the legal tools to bail them out. $50 billion of exchange stabilization was not used for bailouts that was assigned to stabilizing the value of the dollar. We believe politicians did not want to change existing rules to save laymen and be seen as bailing out banks. It used laymen as an example, and this demonstrated the repercussions of no Federal Reserve guarantees, such as the lender of last resort. This resulted in the stock plummeting and consumers worried their life savings were going to vanish.
Citigroup is a multinational investment bank that's headquarters are located in New York. Their heavy involvement in the subprime mortgage crisis led to the threat of bankruptcy in the 2008 global financial crisis. They had large holdings in collateralized debt obligations that were made up of mortgages whose owners were unable to afford interest payments. These assets dramatically lost their value, which led to politicians changing their stance on bank failures after the previous bankruptcy of Lehman's. This led to Citigroup being labeled as too big to fail. Relief programs were introduced, such as TARPs, to ensure Citigroup stayed a going concern, which eventually led to the Treasury's large ownership of Citigroup's preference shares as compensation.
We believe the United States government made the right decision to bail out Citigroup during the GFC. Citigroup received $45 billion from TARP, and an additional $306 billion of their toxic assets were backed by government guarantees. 90% of their losses were covered by the Fed and FDIC. The cash injection led to the shares in Citigroup to increase by 58%. The bailout allowed Citigroup time to slash payroll, shed assets, and boost the efficiency of the bank. It took 5 years for the bailout to be repaid.
The immediate positives of Citigroup being bailed out was that the financial system was temporarily stabilized. This enabled the banks to decipher plans to fix their operations. Following the collapse of Lehman Brothers, faith in the financial sector was low and confidence in the government was down, all of the signs of a depression. Therefore, by introducing new legislation that enabled saving globally systematically important banks, faith in the financial sector was restored. Customer deposits were saved in the short run, which meant there was no risk of a bank run and showed the public that the government would intervene to stabilize the economy. The upside to the bailout was that the government was able to make a profit of $15 billion from selling the preference and common shares of Citigroup. Bush stated that saving Citigroup was crucial to safeguard our financial system, and we firmly believe that this is true. If Citigroup were not bailed out, the global economy would have faced even more havoc than was already seen. The negatives of Citigroup being bailed out was that the management were allowed a second life despite being big players in the collapse of the housing market and the subsequent financial market crash. Some critics believe that there was an aspect of bias to certain banks called too big to fail banks, as some were not given any help and others received billions of dollars in cash and government guarantees. Ultimately, it is taxpayers who bear the burden of the bailout. The major negative impact of bailing out Citigroup was that many consumers questioned whether this would only entice large banks to further engage in moral hazard in the future, as they know that they're too big to fail and the government will bail them out. If the government had not intervened and saved Citigroup, the effect would have wreaked havoc on an already crumbling global economy. So the bailout of Citigroup was illustrative of the US government signaling to consumers that they would do everything in their power to ensure that consumers' life savings and investments were not totally lost. What could have ensued was far worse than spending billions on bailing out Citigroup. Over 30 million Americans had deposits in the money market, totaling $3.5 trillion. So if Citigroup and other banks were left to fail and a bank run ensued, not only would those people get hurt, but so too would the operations of companies relying on financing. The United States was in a full-blown credit crisis, so if the US government had not bailed out these large banks, credit would have stayed in this way, meaning no bank-to-bank lending and interest rates in the US would have soared. The effects could have rippled further into the economy, and a loss of faith in the banking sector would have caused more damage than was already seen.